Hi, welcome to the Scaringi Law Lunch Break. This is your opportunity to learn a little bit about the law while you enjoy your lunch. The Tax Cuts and Jobs Act has gone into effect now, and people are starting to see the impact as they are filing their individual taxes this year. A lot of people have been noting that where they received refunds in previous years, they might not be getting those refunds this year. And to some extent, I'm not sure that that is correct. To some extent, that may be the case. One thing that you should keep in mind as you are preparing your taxes or having your taxes prepared is that there have been some very significant changes. It makes sense this year, more than in previous years, to make sure that your taxes are prepared by someone who is an expert, who knows what they're doing, and who can make sure that they do claim everything that you are entitled to. I recently sat down with some tax software. There are a number of software providers that promise to walk you through everything that you need in order to prepare your taxes correctly. I looked at it, and I'm not going to say which software provider it was, but as I looked at it, I noticed that there were several very important, very common items that it missed and did not just walk me through conveniently. It's entirely possible that if you are preparing your own taxes, that you may be looking at this and saying, the tax law changed, and all of a sudden I'm not getting all of these deductions that I'm used to getting. Well, it may not be that the tax law changed those items, but that your tax software has not been updated to fully accommodate those changes. I think it's important that you understand what your deductions are and how those have been affected by the recent changes. The most significant change for individual taxpayers this year is the change in the standard deduction. The standard deduction amount increased significantly this year. Why that's important is when it comes to itemizing deductions. In previous years, pretty much anyone who owned a home and had a mortgage would itemize their income tax deductions. A lot of the tax advice in recent years was based on maximizing your itemized deductions so that you can get as much of a deduction as possible. This year and going forward, I'm not sure that that's really the right advice for people. I think that the standard deduction is going to be the deduction that most people claim. For example, in previous years, the deduction for someone who was filing single was $6,350. Well, now it's $12,000 just for one person filing their return. And for someone who's filing married jointly, it's double that to $24,000. Those numbers are a lot harder to beat, and ultimately I'm not sure that it makes sense for you to try to maximize deductions to beat those. This year, more than in previous years, I think that it is important that you know what deductions are still available and how you get those deductions, whether it requires you to itemize or not, because there are deductions that you don't have to itemize to claim. The itemized deductions, which were pushed in previous years, include medical and dental expenses, state and local taxes, mortgage interest, and charitable contributions as the largest itemized deductions. And those are all still there. They do have some more limitations than in previous years, but they do still exist if you are able to itemize your taxes. There are a number of other itemized deductions that have been eliminated, including employee business expenses if you bought work boots or a work uniform, for example, tax preparation fees, investment expenses, job search and moving expenses, hobby losses, and casualty and theft loss. Those were really less common, so eliminating those I think is not going to affect as many people. I think the main impact on the majority of people is going to be that it just doesn't add up to that standard deduction anymore, so it doesn't make sense to try to itemize. I think the place where it's going to make the most sense for people to pay attention is not the itemized deductions, but the deductions that you don't have to itemize to claim. Those are called on the tax form adjustments to income, or by most preparers and CPAs, they have been called above-the-line deductions. Those items include educator expenses. For example, if you're a teacher and you need to provide Kleenex and pencils and various supplies in your classroom. self-employment, health insurance, tax, and retirement account contributions if you're self-employed and you have those expenses, health savings account contributions, IRA contributions, and importantly for a lot of people, student loan interest. Now, those are items that your software may or may not walk you through if it determines that you cannot itemize your deductions. And it's important to make sure that you do cover those. If you have any tax questions, or if you want help preparing your income taxes, please call Scaringi Law and schedule a consultation. I'll be glad to meet with you and talk over your concerns.